What's up, traders, and welcome to this free training on reading trend and understanding structure. I'm really excited to bring you guys this training video today. Reading trend and understanding structure is going to be one of the key foundations to your trading success, and if you go on without this skill, if you try to go further without first understanding how to read structure and how to read trend, then you will inevitably have problems later on in your trading. So this is going to be the foundation of good trading, is understanding when the market's in an uptrend, when the market's in a downtrend, when it's in consolidation, and how to actually use those things in your trading plan, in your trading strategies. So that's what we're going to be going over today. I will let the intro and disclaimer roll, and I'll be right back to start today's free training on reading trend and understanding structure. Welcome back, guys. So what is the purpose of reading trend? That's the first question we need to ask ourselves. Why is it important to be able to do this? Why is it important to know how to read trend and structure? Well, because it makes a lot of sense to get involved based on the prevailing direction of the market, the previous direction of the market. If the market has previously been going up, then the chances of that trend continuing are pretty high. And the same thing if the market is going down. If the market's been going down, then the chances of the market to continue to go down or continue that downtrend are higher than the chances of that market reversing. So what it's doing is actually giving us a slight statistical advantage by trading with the trend. So understanding when the market is in trend is a pivotal part of being able to do that. And that is a very simple answer to that question. We can go a little deeper into that and say also that being able to read trend and actually creating objective rules for understanding and reading structure and trend gives us a huge advantage when it comes to creating some type of strategy or some type of trading plan. Let's consider this. If our objective rules for a trend is a series of higher highs and higher lows, and that's what we have right here, is a high followed by a higher low, a higher high and a new higher low, and if that is our objective way of reading trend, then we actually have a verifiable way to test things in the market based on this knowledge, based on this way of identifying trend. We could actually go through the markets and test how many times after the creation of a new higher low and a new higher high, we got a new higher high before the market broke below our previous higher low. And I hope I'm not going too fast for some of you guys, so let's go over that one more time. A trending market is defined as a series of higher highs and higher lows. So if this market is defined as in an uptrend, if we have a series of higher highs and higher lows, what we can actually do is go through the market, go through historical data, and verify whether or not a series of higher highs and higher lows gives us a statistical advantage over the market. So the way we would do that is wait for this situation, wait for the market to make a higher high and a higher low, and then see how many times out of 100 or out of 1,000, depending on the sample size you want to use, did the market continue in the upwards direction before breaking below our higher low. So what we would need to see is how many times did the market continue in the uptrend or downtrend, depending on the direction of the market, before breaking above the previous outside return or the previous pullback. And that's just one thing we can test. Now that we have these rules in place for trend, for identifying trend and identifying structure, and we're going to get a little deeper into identifying trend a little later in the video, but just to go over the purpose of knowing how to read trend and read structure. Another purpose of this skill is so you can create an objective strategy to give yourself an edge over the market. Now that we have our objective rule for identifying a trend, an uptrend, a series of higher highs and higher lows, once we get this series of higher highs and higher lows, we can now create a strategy around that. We can go through the market in historical data and check to see, okay, now we have a higher high. All right, each time we get a higher high, just to go through a simple strategy creation with you guys, each time we get a higher high, and we'll use the Fibonacci retracement for this example, we go from our previous higher low up to our higher high, and we trade the 618 retracement. Now, again, guys, this is just an example of strategy creation, an example of a way you could use your objective rules for identifying trend in order to create a trading plan around it. But you could use that 618 retracement as a buying opportunity to hop on the underlying trend. So hopefully now you're starting to see the purpose of being able to read trend. Once we have rules in place for trend identification, then we can start to create strategies and even a full trading plan around that ability to identify trend. So now that we know the purpose of identifying a trend, now that we know the purpose of being able to read structure, let's get into the exact rules, the objective rules we can use in order to do so. All right, guys, so we're actually going to use a downtrend for this example. A downtrend is defined as a series of lower lows and lower highs. And an objective rule that me along with many traders use for this scenario is called the lower low, lower close principle. And in that case, what we're looking for is a market not only to break below this low, which might look something like this, if the market was to just break below that low and then create a wick below this previous low, then that would not necessarily mean that this trend is going to continue in the downward direction. As a matter of fact, that means we have a lot of buying pressure at this previous low. So what we want to see is not only a break below that low, but also a candle close below that low. So if we get a break below that low, it would look something like this, where a wick shoots down below the previous low and then pulls back up, but the body of the candle closes above this previous low. What we want to pay attention to is the body of the candle. So what we would look for is a situation more like this, where the body of the candle closes below our previous low. That is considered a lower low, lower close, and that's how we identify a downtrend. We're looking for the market to create a series of lower lows and lower highs, and we want to see the market closing below those previous lows. And something we consider at this point, once we get a close below that previous low, is that this market should continue lower. We should create another lower high and another lower low, as long as we continue this process. And this lower high cannot break above our previous structure highs. If it does, then we consider that a possible trend reversal. At that point, we're looking for a series of higher highs and higher lows. And that's a little more complicated than I'm going to get into here today, but what we're looking for during a downtrend is a market that does not break above its previous highs, and all that really means is that we're creating lower highs. As you can see, our high here is lower than our previous high. So as long as the market continues to make these lower highs and close below these previous lows, then we are still considered in a downtrend. That is an objective way to define a trend. And the exact opposite of this exists for an uptrend. So for an uptrend, we'd be looking for a higher high, higher close than the previous highs. And a situation that often comes about that most traders really get confused around, that I get a lot of questions about, is what if we have trends inside of trends? And I know that sounds confusing, but I'm actually going to go over that with you guys here pretty quickly. So what that means is if we have trends inside of trends. What if we have a market that looks like this, and then all of a sudden we get a pullback that looks like this? Is that not now an uptrend? We have a series of higher highs and higher lows. Is that not considered an uptrend? And for me, the answer is no. See, we still have not broken above our previous structure high, which is here. So we have a market creating lower lows, lower highs, lower lows. And even if this market, while pushing up to our previous high, creates higher highs on the way, I still do not consider this a trend reversal unless we break above that previous high. So I'm still considering this market in a downtrend until we test this high over here and break and close above it. Now, of course, this is just a very simple way to read and understand structure. There are exceptions to these rules, but those are a little more advanced, and that's something that we go over in the EAP along with in the structure-based training course. But for today's video, we're just going to talk about how to read trend and objective rules we can use to identify trend and understand structure. So although this may happen, our presumption is that as long as the market does not close above the previous lower high, we will still see an equal to or lower low. So the market is still considered in a downtrend, even if we have a pullback that looks like that. And if you think about it, guys, what do these pullbacks look like that create higher highs and higher lows? They look like an age-old pattern that has been used to take advantage of trend continuation for a long time. They look like a flag pattern. So now that we've talked about the objective rules that we're going to use to identify trend and understand structure, let's head down to the charts and take a look at a few examples. Alright guys, so before we take a look at what a trending market looks like on a live chart, First off, I want to show you guys this so that you completely understand the market is not always trending. Markets go through periods of consolidation that can last a very long time and can be completely unpredictable. During these times of consolidation, any trend trading strategy is going to suffer. And it's very important that you understand that so you don't go into it thinking that just because you understand how to read trend and structure, that means that you're going to win 90 to 100% of your trades, because it doesn't. It's completely natural to lose trades. Your main objective is to either have a positive enough reward to risk ratio to counteract the losses you go through during a consolidating market, or have a high enough winning percentage to give yourself an advantage over the market. And again, that's a little more advanced, and that goes more into trading plan development, but I just wanted to make sure that you guys understand that the market does do periods of consolidation, and what we're going to do is just go through this period of consolidation, pointing out the lows and the highs, and go ahead and point out the trends that exist inside of this consolidation. So if we take this point up here as our starting point, we have a push down to a low, a push back up to a lower high, and a push down to a low. Now, with this being the case, this is our first 3-point move that would indicate a downtrend, correct? Well, during periods of consolidation, the market does not like respecting the rules of trend trading. So instead of only coming up to our previous high or below our previous high and then dropping like our expectations and our rules tell us should happen, the market does something a little bit different. The market pushes up and breaks above our previous lower high. Now, we talked about this. This is our reversal signal. This tells us that now we're looking for higher lows and higher highs. And that actually does happen. We have a little pullback after this that creates a higher low, possibly giving us an opportunity to trade, and then another higher high, putting us into an actual uptrend, a higher low, possibly giving us an opportunity to get into a trade, and another higher high. This is a really good example of what a lot of traders get confused about. So if we take a horizontal line and I place it right here, this is our previous higher low. Now, until this higher low is broken and closed below, we are still considered to be in an uptrend. You see the advanced pullback here that happened. We had a push down to a low, a push back up to a high that was actually lower than our previous high, and then a push down even lower, break and close below this level of support. But remember what we were talking about earlier in the video. Until our previous higher low is broken and closed below, this market is still considered to be in an uptrend. So let's go ahead and delete these and continue the process. So at this point, we have to mark to our next close below this level of structure, which would be from our high here down to our close below low. And now that this happened, this is a possible reversal signal, and we can wait for a lower high. Here comes our lower high in through here, and actually that's going to be right here. And then the market breaks below again our previous low. And the reason this is our previous low is because it's the first low that broke and closed below our previous low here. And guys, if that got a little confusing, then just go back and rewatch it. This is a somewhat advanced concept to grasp, but if you watch this video a couple of times, I'm sure you will start to get it. So now that we are considered in this downtrend, we have our 3-point move, our low that breaks below our previous low from our uptrend, then a lower high, and then another low created. We expected this market to drop before going above this level of resistance. Now, again, in a period of consolidation, the market does not like to cooperate with trending analysis. So what happened? Well, the market went up instead of down. So now we have to grab our line tool and go from our low that created our downtrend. Now we've pushed up, we've broken above our previous high here. And the reason these two highs here and here are not our previous highs when reading trend is because this was our most previous lower high. We have a high here, a break and close of that level, and then our lower high. This lower high is the level we're paying attention to while reading trend. Now we've pushed up and created another high. We pulled back, and then we create another high, putting us into a bullish trend, correct? Again, in consolidating markets, sometimes this market does not cooperate with our analysis. So because of this, the market then breaks into new lows, breaking our previous low, and putting us into a downtrend. So that's a look at how consolidating markets can make it really tricky to understand trend. But if you read trend the correct way and you have a correct risk management plan in your trading plan, then you can fight through the drawdowns that come with consolidating markets and still be profitable using trend trading strategies. That's how a number of different traders become professional and profitable. And now that we've looked at the negative side of trend trading, let's take a look at a market that is actually trending and see how this rules-based way of looking at trend works. Alright guys, so here we are in a market that is actually trending really well. So what we have is an initial starting point here. And if we go from this low up, we have a high, then a higher low, a new higher high, a new higher low, a new higher high, a new higher low, break and close above, then our higher low, break and close above, followed by our higher low, and a break and close above again. Now this is a good example of a market that is actually in trend, and as you can see, using the rules we've created would have paid off very well while the market was trending. So what we're looking at here is waiting for the market to break and close above the previous highs of structure. So we have an initial move up followed by our pullback, and then we're waiting for the market to break above our previous high. And once that happens, we can consider this a higher low. We have to get the market breaking above this previous high before we can consider this our higher low. And the same thing happens again. Now we've broken above again, and we have to wait for the market to break and close. If I pull the chart over, you can see what I'm saying. Now that we're at this level, we have to wait for the market to break and close above this high before we can consider this our actual higher low, because we have enough room down to this area. The market can make new highs and new lows all the way down to that zone, and as long as we continue up after that, this is still considered an uptrend. So we have to wait for the market to break and close above this previous high before we can consider this a higher low. We get that break and close right in here. So then same thing, we have to move our horizontal line up, and we're waiting on the market to break and close above this level, and now this is considered our higher low. And the reason we're pointing out these higher lows, guys, is because if I take another horizontal line, we'll do this one in blue, this is the level that the market cannot break below. If the market breaks and closes below our blue line or our previous higher low, then that indicates a reversal in the trend. So here we're waiting on the market to now break our new higher high here and close above it. Once we get that break and close above that higher high, this level becomes our new higher low. And now we just continue to move up with this process. Now that we have a break and close above this higher high here on this edge of the chart, now that we have that break and close above this higher high, we can consider this our new higher low, and so on and so forth, guys. So that's a completely objective way to identify trend and to start understanding structure. This is just how the market moves, guys. It moves in trends, and then sometimes it will be in a period of consolidation. Uptrend, downtrend, or when the market's in consolidation, the point is having objective rules to identify structure and trend is going to be a key part of you becoming a successful trader. So I hope this video helped out with that. I would suggest that you go out in the market and start drawing lines just like I've done here on your break and close above highs and your new higher lows, and your break and close above highs and new higher lows, and so on and so forth, to get your eyes accustomed to spotting this type of trend continuation and to get your eyes accustomed to spotting these rules. Now, if you have any questions about structure or any questions about this video, then you can email me at steven@thetradingchannel.net. And if you'd like to further your education and learn some of the more advanced techniques that I use in my structured trading, then make sure to keep an eye out for a new course I'll be releasing called the Structured Trading Mastery Course. If you have any questions about that course, then again, just email me at steven@thetradingchannel.net. I hope you guys have a great rest of your day. I wish you all the best of luck in the markets, and I'll talk to you in the next video.